When investors talk about returns, they're usually thinking in terms of dollars gained. But for the IRS, what matters just as much is how those gains are categorized, because the tax treatment can make a major difference in what investors actually keep. There are two broad categories of investment income: earned income and portfolio income. Earned income comes from active work, salaries, wages, tips, and commissions. Portfolio income comes from investments, interest, dividends, and capital gains. Let's start with interest income. Interest from corporate bonds, agency securities, and treasury securities is always taxed as ordinary income. It's reported in the year it's earned, even if the investor doesn't withdraw or reinvest it. There's one big exception: municipal bond interest. Interest on most municipal bonds is exempt from federal income tax. And if the investor lives in the issuing state, it's often exempt from state and local tax as well. However, interest on corporate and treasury securities never gets that treatment. Those are fully taxable at the federal level. Now, dividends can be tricky because not all dividends are treated the same. Qualified dividends, typically those paid by U.S. corporations or qualified foreign corporations, are taxed at the lower capital gains rate. Ordinary dividends, such as those from money market funds or REITs, are taxed at the higher ordinary income rate. The exam may ask you to distinguish between them, so remember this. Qualified dividends equal lower tax rates. Ordinary dividends equal regular income tax rates. Now let's move to the big one: capital gains and losses. Whenever an investor sells a capital asset, a stock, a bond, a mutual fund, the difference between the sale price and the cost basis determines whether there's a gain or a loss. The formula is simple. Capital gain or loss equals sale proceeds minus cost basis. If the result is positive, it's a gain. If it's negative, it's a loss. But timing matters. If the holding period was 1 year or less, the gain is short-term and taxed as ordinary income. If the holding period was more than 1 year, the gain is long-term and taxed at the lower capital gains rate, typically 15%, though that can vary by income level. Losses also have tax value. Investors can use capital losses to offset capital gains dollar for dollar. And if total losses exceed total gains, up to $3,000 of net losses can be used to reduce other income each year, with any remaining losses carried forward indefinitely. Here's a quick example. Suppose an investor has $10,000 in long-term gains and $13,000 in long-term losses. The result is a net capital loss of $3,000, all of which can offset ordinary income this year. Now let's talk about cost basis. Cost basis equals the purchase price plus any commissions or fees paid to acquire the security. If a stock is purchased for $40 per share and there's a $1 commission, the cost basis is $41 per share. Over time, that cost basis can change. We call that the adjusted cost basis. Stock splits, dividends, mergers, or reinvested capital gains all adjust the basis. For example, in a stock split, the investor's total basis stays the same, but the per-share basis declines because there are now more shares. When selling shares that were purchased at different times and prices, the IRS allows 3 identification methods. 1. FIFO, first in, first out, assumes the oldest shares were sold first. 2. Specific identification, the investor specifies which shares are sold. 3. Average cost basis, mainly used for mutual funds, where shares are purchased over time through reinvested dividends or systematic investing. There's also a critical rule called the wash sale rule. If an investor sells a security at a loss and then repurchases a substantially identical security within 30 days before or after the sale, the loss is disallowed for tax purposes. Instead, the disallowed loss is added to the cost basis of the new shares. This prevents investors from creating artificial tax losses while maintaining the same position. For example, an investor sells XYZ stock for a $2,000 loss on December 15th, then buys the same stock back on January 5th. Because that's within 30 days, the wash sale rule applies. The loss isn't deductible now, but it's added to the cost basis of the repurchased shares. For mutual funds, reinvested dividends and capital gains distributions increase cost basis. Each reinvestment counts as a new purchase, and that's why average cost accounting is so useful. It simplifies years of reinvested activity into one averaged basis per share. The IRS also tracks the holding period. For most securities, The holding period begins the day after the trade date of purchase and includes the day of sale. Inherited securities are always considered long term, no matter how long they were actually held. Gifts, however, carry over the donor's cost basis and holding period, unless the market value at the time of the gift is lower, in which case special rules apply for determining losses. Let's tie this together. When analyzing an investor's tax situation, you'll need to remember three key ideas. 1. Interest is usually taxed as ordinary income. 2. Dividends may qualify for lower capital gains rates. 3. Gains and losses depend on the holding period and cost basis. If a question on the exam asks which investment is least suitable for a high-income investor, the answer often involves taxable income, like corporate bonds, while municipal bonds tend to be more suitable because of their tax-exempt interest. Understanding how income and gains are taxed doesn't just help investors file returns. It's essential for building portfolios that fit their goals and circumstances. Tax efficiency can be as important as performance. Next time, we'll turn to how those principles apply in real life, through estate and gift taxes, trusts, and the taxation of various investment vehicles. The parts of wealth management where the financial plan meets the tax code.